Anna, welcome to Validated.
Thank you for having me.
Great. I'm excited about today's conversation. I want to talk a bunch about stablecoins. I want to talk about the problems with stablecoins, stablecoin infrastructure, the whole new area that's sort of getting known as like PayFi, which is like all of these crypto-powered innovations and stablecoin-powered innovations in what's going to be possible from a finance perspective, from competing with companies like Affirm and doing it all in ways that don't require big centralized authorities and credit scores and all these traditional things you see in the sort of payment and finance markets today. But before we get started, you actually used to work at the Solana Foundation, and you left about 4 or 5 months ago to found a new company. Tell us a little bit about that.
Yeah, I used to work at Solana Foundation. I back in 2022 when nobody else was talking about stablecoins. Literally, I was asking around if who our contact was at Circle and Tether, and nobody knew. That's when I started becoming really interested in stablecoins. Long story short, worked on stablecoins, growing stablecoins on Solana until earlier this year when I realized there were going to be a endless number of stablecoin issuers and stablecoin adoption coming on chain. And there is simply no infrastructure serving those stablecoins. Perena was founded to support liquidity, interoperability, and capital efficiency of stablecoins. Now on Solana, we're actually live, or we're just testing with friends now. But by the time you see this, you should be able to use us.
Awesome. And so give me a little rundown of like, what does that mean, right? Like there's this thing that happens in like, if you're listening to like an episode of Odd Lots or something like that, where someone will come on, they'll talk a bunch about like, oh yes, we do risk adjustment, capital hedging for large banks and balance sheet transfers. And like, it's a lot of stuff that like you can look in a textbook and understand, okay, I understand what the functions of these things are in an economic system. We all know about the importance of liquidity provisioning and balance management and those sorts of things. What does that actually look like from both an operator and a builder perspective? Like, what type of infrastructure are you building? What is missing today in the industry? And like, what are some of the pain points for the non-retail uses of stablecoins?
Let me give you the value chain overview of stablecoins beyond just Solana. Let's say like entire
Yeah,
stablecoin industry. So let's start from the beginning. You have the underlying layer of custodians and the actual fiat real world custodians. You have the license regulatory framework. Then you move on to the issuer, the attestation auditors, not the smart contract auditors, the like fiat balance sheet auditors. From there, you start moving towards on-chain. So on the on-chain part, there's the blockchain, which is the infrastructure. There's liquidity layer of stablecoins on-chain that is currently not so efficient. So what are stablecoins? They're like digital dollars. You have both the transfer of digital dollars, the storage, and then leverage and yield. So leverage and yield are two sides of the same coin. For that, nowadays, there's mostly done via borrow lend. You can go higher leverage if you're willing to supply, let's say, stablecoins for high yield with potentially the risk of blowing out. But on that front, I think most of the borrow lend is all borrow lend on chain purely is over collateralized. On the swap
right.
front, almost entirely it's AMM based. Sometimes it's a automated market maker. Sometimes it's limit order book. Very occasionally you get to see RFQ, request for quote, and then you get to see dark pools. And then there's the OTC front, which is arguably not on chain, although it settles on chain. So those are the swap front. There are not many projects thinking about this from both the movement of money and the leverage and yield of money. So when I look at how we approach this problem, when I first started thinking about how to build a better stable swap that allows not just many stablecoins to swap with each other, but also across different currencies, traditional AMMs, even in the EVM world, like Balance or Curve, they stop at 3 tokens, like a tri-pool. And on
Yeah.
Solana, Meteor has a quad pool, but it's not very well utilized. My guess is that there's not that many people just in the on-chain world thinking about how to make all these stablecoins interoperable. And it wasn't an issue before because they were really just a duopoly. But moving forward, we're starting to see like PayPal. PayPal was added, and no tribe pool supports PayPal USDC USDT. And I bet there's going to be more coming in that are equally blue chip. So on the regulatory side, let's go back to a step onto the value chain. On the whole like off-chain component, that part is becoming more and more mature. Therefore, funneling a lot of really good stablecoin issuers that are either the issuance as a service, like Paxos or Braille or Bridge, or the companies behind them that are powering this, such as PayPal or Robinhood or like Anchorage and all those. Um, so having a lot of these stablecoins with similar regulatory frameworks means that you're starting to see similar risk profiles for these stablecoins. And that is what give me the confidence to say, okay, if all of these, like all three stablecoins are issued by NYDFS framework with Paxos, so NYDFS is New York framework, with Paxos, the same issuer, but they just have different names because they have different partners, why can't we put them together? Because they essentially are fungible, but previously only fungible with the actual issuer. So let's say Paxos, you have to take USDP, which is Paxos Pax dollar, and you take PyUSD or PayPal dollar, PayPal USD. Both are stablecoins, same issuer, same framework. On chain, there's really not a lot of ways to swap them, but it should be the case that you can swap them. So we're trying to build that where over time, more and more stablecoins can settle without users necessarily have to like scratch their head around which ones to go.
Yeah. So I think this all like makes a lot of sense when you say like, oh, something issued by Paxos under the hood should have the same security as anything else issued by Paxos. And I think we see that is the default assumption that most of the traditional financial space runs on. I don't really have a preference if I'm getting a, cashier's check from Bank of America or from Chase Bank, but we actually have specifically seen one Paxos product not be treated like other Paxos products, which is, of course, BUSD from Binance, which a few years ago got into some trouble, actually ended up getting completely unwound as a product. And I guess what you'd say is, while that may have been a politically disruptive, socially disruptive event, it's not like anyone got liquidated in a Terra situation. Like Paxos still had the dollars in the bank, even if there were regulatory concerns about how much diligence Binance was doing on the holders, right?
Yep. Correct. So when you look at regulated stablecoins, and if you ask like Austin Campbell or the co-founders of Paxos, they'll tell you very proudly that they got billions of requests to burn per day, and they were able to process all of them. So I think it shows that as stablecoins are often considered to be the narrow banks, this gets a bit into banking history, but
Yeah.
most banks run fractional reserves.
Yes.
Narrow banks are a type of banks that don't. Due to ABA, American Bankers Association's efforts of not wanting stablecoins to grow in that way, and blah, 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 but narrow banks are not really a big thing in banking. However, stablecoin issuers are kind of a type of narrow banks because they 100% hold the reserves, sometimes more. And they're if run properly, they're very, very resilient to bank runs. So I think it's actually quite a feat that Paxos and BUSD was able to support all of this in a very quick manner.
Yeah, I mean, the same thing sort of happened with Circle, right? Where they had a bunch of money, not a bunch in terms of percentage, but whenever you're dealing with 20s or 50s of billions of dollars, like a few percentage point is a lot in some banks that went through government takeover and redemption. And I think what you saw was obviously no one lost any money and there was a fully backed up system there. But there was actually less of a depegging event than you might have expected. I think USDC deviated by maybe 7% from what it should have been at like the peak of the crisis.
Yeah, I think there was a flash crash to like 80 something, but it was very, very brief.
Yeah.
Um, Actually, I was listening to a book on FDIC recently, and there's been since 2022, there's been a couple hundred, if not over 1,000 banks that went through FDIC forced buyout and restructuring. So like central bank and FDIC as like lenders of last resort and the ones that will bail you out. Um, they don't really extend to stablecoins. This is where I think stablecoin future of stablecoins
Yeah.
will be affected. Is that we're always like the not we, but like stablecoin issuers are often feel like they're the second class citizens because they're running on both full reserve. They run higher regulatory burden and compliance burden in many cases. They don't get that FDIC support or regional country by country FDIC equivalent support, and yeah, they're much more limited in what they can do. If I were to
Yeah.
guess in the future, maybe they will. This is like unbundling of the stack. Like banks are a monopoly. Banking business in the United States is a monopoly, monopolizing business due to various reasons. If you talk to anybody who's tried to buy a bank, they'll tell you that. But stablecoins allow banks to allow this to unbundle on the stack because lending you can go on chain. Pre-funding you can use wallet infrastructure. FBO accounts, you can use wallet infrastructure. Under collateralized loans, you can work with prime brokers. Like all those things are great, and you just keep storing money to the very basic, pure function of here's a dollar, and I promise you, you get a dollar back, which is pretty awesome.
Yeah, it's funny because you sort of have the perception of insecurity like a money market fund, but you don't get that 4.25% yield on it.
Yeah,
Which is interesting because, if you go back to FDIC, I think since 2009, there has not been a single case where FDIC did not make every customer of a bank whole, even if their balances were over the nominal
mhm,
number that FDIC says it will insure, which is sort of an interesting thing to look at. It's also a self-funded reserve in large parts, then backstopped by the government. Like banks have a mandatory FDIC insurance fee that they have to pay into, which is interesting because there's sort of a question of, well, why wouldn't that insurance fund technically be available for anyone that can meet the same requirements that a bank holds, but it's attached to a charter, right? Not
yep,
necessarily a reserve structure.
exactly. So to add on to that, it does have a so the reserve. So when you FDIC when you buy out a bank, there's an option. So FDIC when a bank is going under,
Yeah.
FDIC will come in and they'll say like, "Hey, other banks, call up their friends. You want to buy this bank and their assets and liabilities." And some banks will take a look at it and be like, "I'll buy all their assets, but I don't want to, or I cannot afford to buy some of their liabilities." So FDIC takes some of that on, which ultimately gets passed to the government. So again, the government is supporting some of that. And the funny part is this. Um, I was reading about this and thinking that wow, the people have spent of years having the same conversation because in the 1800s, UK went through the same thing, and then early 1900s, the US went through the same thing, and people kept the downside to that is if the government and banking regulators support this, then all the banks have max incentive to keep their leverage or
Yeah, it's a
reserves as
risk
low
on
as possible.
incentive.
Yeah, it's a risk on incentive, and stablecoins simply don't have that. And I
Yeah.
think it's pretty interesting that we don't, and we probably shouldn't. Um, this is actually, if you want to talk about this, but like for Tether, Tether is a very different beast from all the other ones, and yet they run, so to say, a pretty robust balance sheet that's not so unsimilar to dissimilar to how banks operate because they have different types of collateral, different types of
Right.
assets on their balance sheet, and some are more liquid and some are less liquid, and that's how a lot of banks look like actually.
Right. I mean, this is the whole private credit crisis argument that, like, for some reason, BlackRock is not designated as a key financial player or organization, even though if you pull them out, a bunch of other things get called and a bunch of things start to break. But going back to kind of the stablecoin moment here, um, I want to go back to a little bit of what you said about how like two-pair pools are very common, tri-pairs are less common, quad pairs and nth pairs are very uncommon. Why is that today? Because I think if you think about it in like the traditional space, like no one ever considers a trading pair problem. Like I'm never swapping, like I can go and I can swap Tesla stock for NVIDIA stock, even though I'm not ever directly trading pair to pair there because there's just a clearing system that's mature and built out and structured. So, like, why do we need end to end pairs and not just more efficient clearing systems through something that's more commonly accepted?
Because we don't have a shared the common denominator of the fiat dollar is not there. Actually, in the like CME in Chicago, for derivatives, you have what's called implied markets. So
Yeah.
you can see certain things are quoted in different assets. On chain, it's a lot more doable. You can literally have any asset be quoted against any other asset, route it through the underlying most liquid pair, and the most liquid pair can be changing anytime. This is, I think, the beauty of on chain. We're not tied to a single clearing asset. It could be Sol, it could be dollar, it could be anything. In the tripole case, where how I design Perena to be really efficient is think of it as like pre-funding for an issuer or for any asset issuer or even any token. So instead of having to put up your new stablecoin against USDC on Solana, you can put up your stablecoin against this currently tripool, but maybe in the future different pool. But this index basket of fiat-backed regulated stablecoins, and now your stablecoin suddenly has liquidity against all three or all however many stablecoins there is in the basket instead of just having one. So it's who knows where the liquidity flow and venue
Yeah.
changes really quickly. Even though like so far in the last let's say 2-ish years, Solana has mostly been going through Sol and USDC. I don't think it's always necessarily going to be the case. Like if wild example, if Google decides to tokenize their balance sheet tomorrow and their stocks and issue a stablecoin, that stablecoin is going to be bigger than any stablecoin on chain right now. Like period.
Right.
So we can tilt that really quickly, and it's hard to if you like design a market that's tied specifically to an incumbent clearing asset that's not even maybe the most optimal clearing asset going forward. I think that market becomes tied down by that pair.
Yeah, it's interesting because I guess I started thinking of a few different pieces here. So the first is like if you are an OG enough in Solana, you remember something called Stable Swap, and you remember what became Saber and lots of problems associated with that. But one of the interesting concepts that they had going back far enough is no one should ever hold USDC or USDT. They should hold a synthetic token that represents a basket pool of, 10 to 15 basis point swaps in and out of stable coins of choice. And there's something very sort of interesting about that. But at the same time, there's something about that that felt almost like a public good. Like in a world of meme coins with 1.5% slippage and liquidity provisioning there, like this felt like it was sort of like the bond market of crypto, like the most boring, stable stuff where there's very little innovation that happens. So what
Yeah.
did you and your team kind of see here that makes you think that not only is this like there's always two problems in crypto. Is it needed and is it profitable? What convinced you that both of those things were true?
It is needed. It is not profitable on its own.
Okay.
I built it this particular module, I thought of it as mostly a public good. However, so here's why I feel like Perena is constantly struggling with like an identity crisis. On one hand, we're trying to serve like fintechs, payment companies that have this need. Let's say PayPal actually, we talked with them. They had people send them like random stable coins and then complain about their money not hitting the PayPal account, and that's like a service we could provide and allow them to swap. On the other hand, this particular service is not profitable in a meme coin environment comparatively. So I think the bigger picture here, the other side of Piranha's identity, that our team is all actually very DeFi native, and we are very passionate about innovating on what money can be, should be, and will be. So we're actually taking like we believe that stablecoins, fiat backed stablecoins that don't even give yield, will exist.
Yep.
However, I think the beauty of where Perena is going is merging store of value and medium of exchange. Most AMMs are not
Mm.
very attractive for LPs, despite their maybe not so accurate 200% APY advertisement. Um, the these stable swaps themselves, let's say they earn 5% per year, or depending on how big Solana's stablecoin economy grows. So that's highly is highly dependent on that factor.
Yeah.
But let's say it grows, we can sustain a TVL of, I don't know, like 5 billion at 5% APY, given a specific number of daily swaps that happens. That's still not as effective or efficient as the on-chain cost of capital at Camino or margin, which is generally risk-free rate plus, or like SOFR plus 5%.
Yeah.
So how do we get there? I think for those who are more DeFi native, we're looking at something similar to a CDP, which is a collateralized debt position model. I won't write this anywhere, but I think I can say the analogy that this is looking somewhat like a future of permissionless on-chain bank, because on one side you have an asset, you have a balance sheet. On one side you have your assets, which are those LP tokens. On the other side, you have liability, which is the minted, which is basically a banknote, but of course we don't call it a banknote. It's like a synthetic money, I would call it. Um, how I got to this conclusion is that AMMs have a ton of money sitting there, rotating maximum 6 times per 24 hours. This is
Right.
maximally inefficient compared to TradFi trading markets. On the other hand, you have CDPs like back in the day, Maker. Now they shifted a bit to Sky, but like Liquidity or Hubble on Solana, they have a lot of assets in there, and those assets are locked up in vaults, and you don't do anything with them. So again, that's like bankers centuries ago figured out that was not the case for capital efficiency. So we merged them, and I'll give full credit here. After I thought about this, I started digging, and I did find that Ratio Finance back in 2021
Yeah.
came up with something pretty similar. And I think Curve CRV USD is doing something similar as well. So this idea is not like new under the sun by any means, but we're trying to push for the my goal is that this type of construct is still extremely fresh in people's minds, that adoption hasn't really taken off yet. And this model could work because it is strictly more efficient than taking in collateral and putting them into some sort of slow moving pool or vault.
Yeah. So how do you think about like risk transfer in these type of systems? Because I think there's like a TradFi answer to this, right? Which is like synthetic risk transfer and like all these other types of products that exist, and like we can debate how well they work, but at least that they exist and there's some amount of math that says like these things can function. When you're dealing with something that's on chain and you're talking about like basically risk positions that are secured by assets, you start introducing you start changing the Sharpe ratio potential of something like this. And I guess the question is like, how do you evaluate what that risk is relative to, like, for example, you were talking about 5.5% yield. You can get about 4.25, 4.15 today in a treasuries backed
Yep.
product, which is effectively a zero risk product. And so that actually might be a fine ratio in terms of additional risk. One might say, I want the extra 1% yield or 0.75% yield. But how do you think they need to evaluate the risk they're taking on through that trade?
Yeah, I think crypto native people and non-crypto native people will give you very different answers.
Yeah.
My After like much reading of banking history, my conclusion is that I would allocate a significant portion of assets to on-chain versions of banks, quote unquote banks, whether that's borrow lend or CDP or other smart contracts that have that couple years of Lindy effect, and the chain is robust. I think that's actually not any less secure
Hmm.
than banking systems in even major countries that have suffered many, many crises in the past. Um, Most of them, I guess, the crypto Gen Z population would not remember, but not that far from history we would be able to see, and it's happened time and time again, similar crises, bank runs, and all that. Crypto is the first time where smart contracts can withstand complete bank runs, and through different mechanisms. One could argue that it's because it's often over collateralized, so by definition, is less efficient. On the other hand, the instant settlement and interoperability allows for looping to get to a similar level of leverage that TradFi has been able to achieve, but with much lower liquidation, much lower cascading liquidation effects, is how I would argue. On the other hand, from a TradFi perspective or traditional wealth asset manager or asset allocator's perspective, I would argue that yeah, it's sometimes not worth the additional risk because it's very hard to evaluate the various facets of smart contract, and oftentimes, like, I don't necessarily want to name specific protocol names, but there, in addition to smart contract hacks where it's like code had some issues, there's many times had protocols gotten exploited because other parts of their tech stack got into issues. So
Right.
the risk is very, very hard to evaluate or insure against fully. And then to your question on risk transfer, CDPs enable customized risk profiles while ensuring unified interoperability. And that is, I would say, similar to, I remember Morpho was kind of saying something similar. So it's not so dissimilar to Borrowlend, but it just spits out like a single synthetic unit of value that allows people to evaluate that, whereas traditional Borrowlend allows you to spit out different units of value, and you have to manage that different units of value. So it's a slightly more complicated user journey, I would say. The risk side, to shield Solana a bit, Pendle has been around Ethereum in the last year, taken off a lot. Solana has RateX, Exponent, and I think one more team building on essentially interest rate swaps. So you are allowed, and it will be possible to segregate risks based on how much of what your appetite is. But that's for like a more risk on and DeFi native audience.
Yeah, so we keep talking about like crypto risk tolerance versus TradFi risk tolerance, and I think um, if you go to the average crypto risk tolerant person and you say you can go a little more risk on and earn 5%, they'll laugh you out of the room because you're like, that's a rounding error, right? Like risk on in crypto is like peanut, and it's
Yeah.
buying Sol at $8 and it's buying ETH at $80 and it's buying Bitcoin at 18K. The definition of risk on is just very differently adjusted. So I guess like the question would be like, is there like a mid-curve market trap here where it's not stable enough for people to feel like it's stable, and it's not risky, and it's not yield bearing enough for people to feel like it's risk tolerant? And then how does that, there's the crypto version of that, and then how does the TradFi version of that flip? And then maybe the third part of this question is like, how there's a whole bunch of other stuff that can come after the infrastructure is built that maybe helps bridge the gap there. What does that look like in terms of future build out?
Let me try to answer this from a few different perspectives.
Yeah.
Yeah, it's like 5 questions in one. So for CDPs, it is better. I was actually writing out a list of ways to get leverage on Solana on Twitter. CDPs are better for longer term leverage because they're cheaper than perps. Um, if you want yield and if you want maximal, basically risk free or near risk free yield, stable swaps are better than holding just stable coins.
Yeah.
They're arguably a little bit better than Borrowland because the assets are fully there. Borrowland, even like Aave, like Mango had a bad debt back in the day. Not really their fault, I don't think, but like it
It
happens
happened.
in extreme cases. Stable swaps, not really, unless that specific stablecoin depegs. Like all their assets, you will always have that N units of stablecoins in the pool at any given time. So that is definitely lower risk. On the mid curve take, I think there's what we're seeing right now in a bull market is even mid-curve people who don't want a 10x long peanut are tempted to 10x long peanut because that's so plus EV to do right now. Like the probability is so skewed. I don't think that should be the case in a stable market.
Hmm.
I don't know, but because it could, one argument I can see is that, okay, the US dollar is destabilizing, markets are going to be like highly volatile going forward. In that case, maybe like the mid curve or the right curve take is just mega long meme coins or like go super hard. And the mid curve is like everybody let's get on risk on. So in that case, maybe some of the things that we're building is less interesting from a trading perspective, but from a payments perspective, the other question you asked, um, the more utility you give to, I'll just be broad here, the more utility you give to on-chain assets, the more likely the on-chain economy grows. So I think of this
Yeah.
as like, it kind of is like a network state, where a global state that's like an orthogonal jurisdiction or culture or community or whatever you want to call it, that is growing over time and attracting different types of netizens. Some whom, like me, I like to 10x long meme coins, and that's okay. Many of whom don't do that, and they're just trying to pay their bills.
Yeah.
And then they maybe leave a little bit of stablecoins. Over time, they become more comfortable with it. They leave some of that stablecoins in their wallet, and they're like, "Oh, okay, I have like 1% of my net worth, 5%, 10%. What do I do with it?" So now they'll go do other things, and some of which I hope is to put their stablecoins into Perena stable swap and earn a very comfortable yield that is safe for them and they can withdraw anytime. I think the use cases on stablecoins are what is really, really exciting for me. And I hope in the next 6 months we'll build DeFi. And after the next 6 months, I'm very interested in building like real world applicate consumer or small business applications for with the DeFi infrastructure that we have. And some that like PayPal emphasized that recently that they're going super hard on SMB ERPs. So it's a
Yeah.
mouthful of acronyms, but really that just means like if you need to send an invoice, if you need to send payroll, and all that could be done on chain. And all those trickle down. I still hold the belief that payroll is the number one way to get people to get into crypto. It's like you get paid earlier, you get paid faster, maybe more, and you take that, and some that will retain in the system, and most of it will get off ramped. But over time, this ecosystem will get bigger and bigger.
Yeah. So one of like the perennial questions around stablecoins is when can I use them for real stuff? And there's a little bit of real stuff you can do today. Like PayPal has helped bridge that down. Like there are some places that'll accept USDC, like Solana Pay does exist. But like at the end of the day, like people need to pay rent, people need to pay credit card bills, people need to pay electric bills, and that stuff, the non-consumer stuff, like that to me feels like a real blocker for payroll when someone says like, okay, great, I want to get a bunch of my or half my paycheck in stable coins and I want to get half my paycheck dumped into my bank. Most of the time when people are saying I want to get it dumped into my bank, it's because there's no stablecoin infrastructure today that I'm aware of that lets me say, can you ACH a payment to my utility provider? Or can you send a wire transfer to X or Y or Z, right? Like how far away and what are sort of the barriers to those sorts of uses?
You know why Stripe bought Bridge? Because they can do that. Um, so yes, you can actually do it with Bridge wrappers, like companies that wrap and build on top of Bridge, to pay your rent or ACH, pay taxes and all that. A couple ones I can think of, not necessarily built on top of Bridge, but there's Parallax, Dakota, Spritz. Um, uh, there's like another, a Cast.
Yeah, but like at some point, like Dakota is not a bank, but it is functionally a bank,
Yep.
right? In the sense of like it has a very similar fee structure to what a bank has. And yes, it's built on chain. And like there's lots of great things that like us crypto native people love about being built on chain. But like it's pretty attractive to say, like, I'm gonna open up an account with Citizens Bank and I'm gonna put some money in it and I'm gonna if I have enough money in it, I'm gonna effectively get a good yield and I'll just pay no account fees. And the promise of crypto has always been, and we see this in a lot of places, that it can massively reduce costs. Right? You see this from like the Robinhood CEO saying like the administration of their crypto trading business is astronomically cheaper than the administration of their equities trading business. There's a lot of places where you see real like cost savings for consumers and businesses in crypto. Why is the sort of ability for me to have an account that can pay stuff to people who don't have crypto an area where I'm actually paying a premium for the ability to do that as opposed to getting a bit of savings for doing that?
Yeah, we're definitely in the early adoption point of the adoption curve. I think not to throw shade on fintech banks, but those are higher risk, and I would not recommend anyone put their entire life savings into a bridge or like equivalent wrapper because you would actually rather have some in like significant or let's just say you want to diversify, whether
Sure.
it's banking or wallets or chains or anything. To the point of not being usable, I think we're just not there yet. In a lot of cases, in my world, my daily transactions to people in the industry is mostly done on chain. I pay contractors, I pay employees, I pay like law firms using stablecoins. And like I said earlier, that orthogonal network state will be grow it is growing, and I think will continue to grow. Um, Perhaps driven by emerging markets, because
Yeah.
that's where the savings are the most significant. And coming back to the US, I'd say if anything, US retail will be the last ones to embrace stablecoin payments
Yeah.
unless Doge moons and then everyone's like, "Oh, hell yeah, I have crypto in my account now." But why I say this is because the FDIC is so protective of retail. I mean, of course, like super protective of those banks, but they've not let retail rug a single time in the last couple decades. So
Yeah.
there's really not a whole lot of reason if you're American living in like a town that never interacts internationally, but for those of us who live in different countries, it's super painful to pay or move money around, and there's like a really big value prop to stablecoins.
Yeah, I think that's a really good articulation of it because as much as we in the crypto industry get upset and dunk on the TradFi industry, it does a pretty good job of
Yeah,
preserving wealth, managing risk, having strong backstops for things like that. Even if your upside potential is limited, your downside potential is very capped.
yeah. I think it depends on how you view it. Like inflation was very steady, but purchasing power was um, degrading very minimally over time until our decade. Really, like this decade is where you kind of, as an average person who's not in finance or crypto, you kind of have to start thinking about this because the CPI is just not accurate, and your eggs are more expensive than your eggs were. Um, so I think more people will become aware, but for what it's worth, TradFi in America has done a really good job protecting the average consumer. You're just losing money on to inflation. You're actually not losing money.
Right. Interesting. So I want to talk a little bit about the pool of things we generally refer to as PayFi, right? PayFi has been it's definitely not a Solana specific thing, but I think it's picked up a little bit more on Solana in part because the transaction fees are low. But as we move into a world where there are many cheap blockchains that are abundant with fast transactions, like what is this new brand, for lack of a better term, all about? Like what's actually under the hood in PayFi that's not just a branding change, but is like a new product class.
I think it's the composability of float, instant float, super short term float,
Hmm.
pre-funding, and again leverage. Um, Let me digress a little bit because at DC FinTech Week, I was with PayPal, Visa heads, crypto heads, and they were like really adamant about saying, "We are payments. We are not banking. Keep stablecoins out of banking." I think that was a very like political take to avoid banking regulators to scrutinize them. However, stablecoins and PayFi and all of that, It's 100% eating banking. It's 100% coming at what banks are able to do. Banks are the only venue for companies like Affirm to pre-fund. You need a pre-fund like however much you're paying out every 24 hours every day. So that flow is not, it's just like pay to play. Banks are not going to give you that flow. Why should they? I mean, they're providing you a service as well, of course, but they're processing your money, and just like your money on Venmo that you requested withdrawal, that 3 days in between, they're not going to pay you anything.
Is it getting longer? Am I crazy? I feel
I
like it
think it's
used
getting
to
longer.
be like 24 hours is what the app
Yeah.
said, and now it's like 3 days.
Now it's like yeah, like Robinhood, I think was like 5 to 7 days. Ridiculous. Um, but anyhow, so all those things in traditional finance, I will give them the credit. I'm not gonna say that they're like, I'll give them the credit that compliance costs are extremely high. So they
Mm.
are incurring costs for helping transfer things and dealing with all the bounce backs and their own systems dysfunctional reality. However, with on-chain, I think you're starting to see that merge, and I'll boldly just hot take say that it is what banking will become. It's combination of processing payments or transactions with engineering. Financial engineering of whether you like ARF and Huma and some of those types of companies that are actually they are processing cross-border payments. They provide that short-term leverage or because you need to borrow some money, and they do that in a much more efficient manner than TradFi. And this is particularly apparent outside of the US because US has one of the best banking system. If you
Yeah.
think about like I can't imagine if you go pre-fund um like Angola or something like that. Those countries run out of dollars, and they if you pre-fund stuff, they might just tell you like airlines that operate out of Nigeria, I think, had to cancel their flights or threatened to cancel their flights because they couldn't get paid, and they couldn't pay their employees,
Hmm.
and those types of things happen again and again. And on chain, it just simply won't happen, or you can fully mitigate those risks.
Yeah. Do you think we're going to see TradFi start to take stablecoins and payments and this sort of infrastructure more seriously? Or do you think we're going to see sort of like a new generation of companies built up around it? Like over the long term, is it like eventually Circle and Tether are just going to get completely eclipsed by JP Morgan coin?
I hope not. I don't think so. Certainly, JP like Onyx team is very sizable. Um, my cynical take is that they publicly, like Jamie Dimon publicly dismissed crypto for the longest time while they were accumulating a bag, and then now that the ETF and all the TradFi capital is in there in crypto, they are now extolling the virtues of crypto, and it really is a game of politics and power. And in the end, I think we've seen this many times. I think incumbents reluctantly will adapt, but it opens up a really big and really good window for new entrants. And the innovator's dilemma happens again and again. Um, Visa is one surprisingly that I think and I really hope they will survive this, but I'm pretty sure new entrants will come in and eventually replace old ones.
Mm.
The only reason why it wouldn't happen is that America takes a very anti-business stance against bank competitors because of ABA's lobbying, and I think many other countries have already seen a different stance. Like fintechs in Asia are extremely powerful and probably better recognized than a lot of their banking counterparts.
Yeah, that's always the thing for me that it feels like the US has a little bit of a protection racketeering ring when it comes to compliance costs. And that is like one of the biggest barriers to entry. Like just in my own experience of engaging with something like a compliance department at a
Mhm.
bank, like I have had my bank try and debank me 3 times. And it's been very interesting to just tell them, no, you're wrong. And eventually they give up, and, like, that is not how I expect compliance works. I expect compliance works much more like a chart, and there's a lookup table, and they say, "You are here on this chart, which means you're in this category, which means, no, we won't service you anymore." Not like if I just write them long enough emails and send them enough pay stubs, they sort of give up, which is like not how I think compliance should work. But is that like most of the moat that TradFi has is just like a a a great firewall of paperwork that protects them?
I think a lot of it is, and coming from an international background, most of US law is like that in every single industry, even for medical. Like
Mm.
US healthcare is the least efficient healthcare system I've ever seen in every country I've lived in. Um, and that's army of lawyers, and they want to lawyers and compliance and all that. And at least from banking AML perspective, we've seen that it's not effective. The stats have shown that it's not very effective at protecting against the type of activities that they sought out to protect. Um, and yeah, I think it's very much a protectionist stance. Like banks, if you buy a bank today, if they let you buy a bank today, within 3 years, you cannot change the bank's charter. If you're trying to do anything, you need to file, you know, I think appeal or apply. And every time you apply, you pay a fee and they can always say no. So essentially, some of my friends are like Web2 fintech founders. And I asked them like, hey, have you thought about buying a bank instead of working with a bank? And they're like, yeah, we try to buy a bank. We put in bids. It's just not really worth it. And that's it kind of is
Yeah.
like somebody described it to me that those guys are like a couple dudes who meet up once a year at like a hotel and decide, okay, do we let banks do this or not? And in the end, it's a very people-driven decision-making process, not a systematized decision-making process. So I think
Yeah.
that's a huge problem for any country to have that.
Interesting. All right. Well, Anna, thank you for joining us today on Validated.
Thank you, Austin. See you next time.